Hello there. Have you ever gone shopping and you've gone to the mall and you just had to pop into that one store that you love? Maybe it's Macy's or Dillard's or Foot Locker or whatever it may be. And you saw that shiny new pair of shoes, that shiny new purse, that watch, whatever it is that attracted you to go into that store. And you just had to have it. Emotionally, it made you feel good. You thought, I need to have this item in order to make my day. And then you buy it and you're euphoric. And then you go home and there's a little bit of regret. There's a little bit of remorse. And you're thinking, did I really need to spend that money on whatever item it is? I'm Sean Lee. I'm managing partner here at Elevator Retirement Group. And today, what we're going to talk about is our behaviors and how it's the initiator of our choices when it comes to money and retirement, and how we think emotionally, how we view money emotionally, and how it either can be a benefit or a deterrent, an obstacle to us in retirement. So what are we going to talk about today? Well, today we're going to talk about a number of things. We're going to talk about types of risk. What are the different types of risk that you can take inside of your plan? Talk about emotions and how emotions affect our decision making when it comes to our retirement planning. And then we'll talk a little bit about investor psychology. And at the very end of this webinar, you'll have the opportunity to wade through some of these issues, concerns, some of this information, and bounce ideas off of an advisor, a member of our team, just on a 15-minute call. And you don't have to come into the office. You don't have to spend a lot of time, but we want to be available to you to answer any questions, concerns, thoughts that you may have when it comes to your hard-earned assets and your money. But before we do that, let's have a little quiz. And if I were to ask you what color is a stop sign, most of you would answer almost immediately and say, it's red and white, Sean. We've been driving for a long time. We know what color a stop sign is. We passed one on our way to work or on our way to school, take our kids to school. That's a simple question. But if I were to ask you what color a yield sign is, what would you say? Think about it. Most people would say what? Yellow and black. I hear that all the time. Sean, a yield sign's yellow and black. And maybe you said the same thing. But are you entirely sure that a yield sign is yellow and black? If you really think about it. Actually, the yield sign is red and white. And the yield sign hasn't been yellow and black, which we immediately go to and what we immediately envision for over 50 years. See, I grew up in southern Wyoming. And in southern Wyoming, if you go out into the desert, out on the dirt roads, there are a lot of yield signs that are attached to railroad tracks still. They may have bullet holes or whatever into them, but they still look like this. They're still yellow and black. When the reality of it is, yield signs haven't been yellow and black since 1971. It was added to the Manual on Uniform Traffic Control Devices in 1954, and in 1971, they changed the yield sign to be red and white. Now, why does this matter? See, the reason that I bring this up and the reason that I talk about this initially when we talk about emotions is that most of us have this old way of thinking where we say, hey, yeah, the yield sign is yellow and black, and we're surprised that it's red and white today. But I ran this a little further. So my son was into trains when he was really little, cars and trucks like any other little boy. And I looked at the yield signs in some of his train sets, some of his car sets, and things like that, and they're actually still yellow and black. So we're pre-programmed as children to believe that something is true when it's not. Our job today is, or as a planning firm, and when we have discussions with people, is to help you filter out a process or help you create a process to filter out the misunderstandings, misconceptions, emotions, so you can make decisions for your financial well-being based on facts and logic. Now, wouldn't you agree that building a plan that's based off of facts and logic rather than misconceptions and emotions would be in your best interest for the long term. So that's what we're going to talk about today. How do we filter out the myths, misconceptions, emotions? But first we have to understand risk. And we have to understand behavioral risk and really what that is and the different types of behavioral risk that are around. So we can pinpoint, oh my God, okay, I'm feeling emotional. I've got some risk here. How do I weed that out, get rid of the myths, misconceptions, and emotions, and follow a plan that's based on logic? So what is behavior? Let's start from the ground floor. So behavior is the way that we're wired, and it dictates how we act, choose, and deliberate about people. With our money, almost everything in our lives is influenced through our behavior. So any human interaction, any decision that we make is built and based off of our past experiences and how we're going to respond to a certain situation. So you go out and you buy that new pair of shoes. You know, I'm a Jordans guy. I love to wear Jordans. I have a pair of Jordans on right now, but I may not need to go out and buy the most expensive pair of Jordans. It may make me feel good immediately, but I may have some regret down the road. So our behavior is how we act and the decisions that we make. So how do we decode behavioral risk? There's really two types of behavioral risk. The first type is systematic risk. And that's really market risk. It's the chance you're going to lose money as a result of the markets. So let's say the S&P 500, for example, and you know there's a bad story in the news that our economy didn't grow like it was expected. The S&P 500 goes down. Well, that's market risk, right? Or there's some great news out in the marketplace and the S&P 500 goes up. So that's the chance that you're going to lose money as a result of the markets. I think that's in your control, but it's in indexes as a whole, for example. Unsystematic risk is business risk. And that's specific to a business. And that's the chance that an investment will lose value due to factors pertaining to that business. So Tesla, for example, Tesla is a great, well-known company. They're a really cool tech company. I wouldn't necessarily call them a car company, but they're a really cool tech company. So if you invest in Tesla specifically, and Tesla has bad earnings report for the quarter, and their stock price goes down, well, that's a business risk. That's a chance the investment loss is going to lose value based on the business itself, not necessarily the whole market. And the third type of risk is behavioral risk. And the effects of psychology on investors and financial markets is really what behavioral risk is. It focuses on explaining why investors make certain decisions and why investors may actually make decisions that act against their best interest that are based on personal biases rather than facts. That's behavioral risk. So you've got market risk, business risk, and behavioral risk all factoring in to your decisions. So what are the types of behavioral risk? And we're going to go into each one of these in a little bit greater detail. First behavioral risk is ego. Second is emotion. Third is attention. And fourth is conservation. So let's go into ego risk to start. So ego risk is the overconfidence or belief that you will consistently perform better than the average. Ego risk leaves very specific evidence. And so ego risk is, I'm going to invest here, here, here because I'm smarter than the institutional investors. I'm smarter than the markets. I trust my skills and my decision-making to do better than an advisor or to do better than the indexes. There's a lot of confidence that comes with ego risk that I can do better than the norm. That's me. I'm that person. I can do that. Emotion risk. Emotion is where we confuse our emotional behavior with our emotions and risk management. So we confuse what's fun and what makes us emotionally feel good with what's safe, right? So we go out and we're talking to a friend, and they start talking about, this really cool stock that they've got into, and it's just skyrocketed, and they're going against the market makers, and they're going against institutional money, and they're doing great right now, and the runway's never going to end, and they're going to continue to make money, and you feel really good about that, so you go in and you buy GameStop. This happened a couple of years ago. I don't know if you remember GameStop's, and there's actually a movie about it now, that GameStop stock just skyrocketed based on emotions and investors getting in and pushing market prices up. Well, the fundamentals of GameStop didn't really say that the stock price should continue to do what it did, but the emotional side of investors getting in and riding that wave and that euphoria pushed that stock along. So that was really emotional for people. Whether it's safe, it's right, or it fits your plan, it was emotional. And when we start to look at the cycle of market emotions, this rings true with any consistent market. So we start to look at, after a market correction, the markets start to go up. So 2009, the first couple of months, we start to see that the markets are correcting, they're going up, they're getting better, and there's a little bit of optimism there. There's some excitement, there's thrill, and the markets keep going. And like, man, I'm the smartest investor ever. I can do this full time. This is great. And you hit this maximum point of euphoria, and you think the ride's never going to end. And then what happens? The markets do what they do, and they correct. They start to go down a little bit, and there's anxiety and denial. And it's, hey, no worries. I'm a long-term investor. I can handle this. Markets continue to go down, and there's fear and desperation and panic. And it's, how could I have been so wrong? And what happens there? You sell. The average investor will sell at that point in time. And then you hit what's called the point of maximum financial opportunity. When the markets are at their lowest, most people are scared to get back in at that point in time. And then what happens? The cycle continues back up. There's depression. There's a little bit of hope. There's some relief. And then you're back to optimism. And then the cycle starts all over again. And you get back in and you start to trade, and you do the same activities. You follow the same emotions. Let's look at attention risk. So attention risk is that the biases that allow our memories to influence our assessment of profit probabilities. Oh, Sean, I've never done well in the markets. I invested in Microsoft one time, and I got out, and I'll never do that again. But I really wish I would have. There's these biases of good experiences versus bad experiences. Now, attention risk does leave concrete evidence, and what we look for and what you'll see with attention risk is that a particular holding is crowded when it comes to trading. There's a lot of trade, both positive buying and selling of a particular holding. There's an over-reliance on excessive stocks, but the bigger correlation, the bigger evidence piece is that there's excessive correlation to certain investments. So investments that do the same thing under equal market conditions are correlated. And those are usually high noise, low probability investments. Coming back to the GameStop stock, perfect example of not only emotion risk, but attention risk, because it was getting a ton of media attention. There's a lot of people in there, and they're pushing that stock forward pretty aggressively. And then conservation risk is really just, let's call that the head in the sand risk. That's sticking with what we know, it's resistance to new ways, and staying with the status quo. So Sean, I've always invested in this, call it S&P 500, or I've always invested in CDs. that's comfortable. That's where I want to be. I'm conserving my well-being because I'm sticking with the status quo. Whether it's best, right, or wrong, for me, that doesn't really matter. I'm comfortable and I have blinders on. I don't want to deal with it anymore. I'm just going to stay here because that's what I know. That's conservation risk. So now let's talk about a little bit about investor psychology. And investor psychology is interesting because it really, drives some of our decision making and how we view risk, right? So investor misbehavior, thinking we're luckier, better, or more prescient than the next person. So Chris in my office, if I've got some misbehaviors going on and he and I are managing money or investing in accounts, whatever it may be, of our own assets, this is me saying, hey, guess what? I'm better than you. My decision making is going to be better whether I have facts to support that or not. It's thinking that I'm going to be luckier because I'm me. It's allowing our gut to rule our head. Rather than going out and getting the facts, the data, and the information, it's thinking with our gut saying, you know what? It sounds like a pretty good idea. Let's go ahead and do that. And listening to information that is loud rather than what's probable. So the noisiest person in the room isn't always necessarily the right person. They may be, but don't follow the noisiest person without facts or data just because they're the noisiest. And then there's the lopsided preferences for safety and status quo. So you can see we've got ego risk, we've got conservation risk, we've got emotional risk here. So these are the types of investor misbehaviors that we need to be aware of so we can continue to make decisions that are fact-based and data-based, not emotion-based. And when we start to look at investor psychology, there's a lot of different gears here. And this came from a 2020 investor behaviors, loss aversion is down in the bottom left, expecting to find high returns with low risk. Then you've got narrow framing, which is making decisions without considering all implications. Mental accounting, taking undue risk in one area because you don't want to take risk in another. So I'm saying, okay, I need to even this out. I don't want to take risk here, so I'm going to take a bunch of risk here. Diversification, seeking to reduce risk, but simply using different sources, right? And then we talk a little bit about diversification in another webinar that we've done and how that can affect a portfolio. Anchoring, which is relating to what's familiar, experiences that you've had, even when they're inappropriate. So we may anchor down into an experience that we've had, but it may not be a fair apples to apples comparable of this new experience, but we're going back in our mind or saying, okay, this is what I did in the past. This is what I need to do now. And it may not always correlate. Optimism is the belief that good things happen to me and bad things happen to others. Now, I'm a pretty optimistic guy, but I don't want bad things to happen to other people. I want good things to happen, but I don't want them to happen based off of my emotions. I want good things to happen based off the facts and the linear progression of thoughts that I've gone through. And I've taken all the data and I've created a pathway to get to where I want to be rather than just jumping at this and that or making decisions erratically. Media response, we're going through this a lot right now. The media response is just all over the place, right? It is, you're seeing, you can go to any different news station, you can go to a lot of different places to get information from the media, and you're going to get conflicting stories, and then it's going to hit you from both sides, and it can be overload, and you're going to react one way or another based on what you read last in most cases. So make sure that we're staying away from the media responses and focusing on the facts. Regret, treating errors of commission more seriously than errors of omission. So it's like, oh man, maybe I shouldn't have bought that stock. It went down. Dang it. And that's regret. But then when you don't buy it, You still have regret. Oh, it went up. I should have bought it. So making sure that decisions are decisions, and being comfortable with the decisions that you make, right or wrong, but understanding that they can't be emotional based. They need to be fact based rather than emotional. And hurting is, back to that GameStop example, is just following and copying the behavior of others. Well, my neighbor bought GameStop, so I'm going to go buy it. Or my neighbor bought Apple and Tesla, so I'm going to go buy those holdings, because that's what the masses are doing, regardless of if there's a potential for an unfavorable outcome. So what can you do now? As you go through this webinar, what are some of the action items that you can go through? First action item I'd recommend is creating a budget. Now, how do you do that? You go through, and in this portal, we've got a budget sheet. You can go through and fill out what your budget is. My rent is this, my mortgage is this, my car payment. I buy food, groceries, entertainment, whatever it may be. The second way to do that is to pull your bank statements for a 12-month period and actually look to see exactly what you've spent. So what do you do after that? Well, go out and meet with an advisor, or meet with 2 advisors or 3 advisors to find the advisor that's the best fit specifically for you. Not necessarily, it doesn't have to be our team. Our team would love to have a 15-minute discussion with you, which we'll talk about in a little bit. But meet with an advisor or a handful of advisors to determine the right fit for you in your phase of life. Gather all the information that you need to be fact-based, and then create what's called a clearly defined plan, a written out plan. And the reason that is so important is that 97% of Americans do not have a written plan for their finances. They will go out and they will plan a trip. I do the same thing. I plan a trip. I will plan my route to get from my house to a baseball field, if that's where I'm going, or wherever, if I don't know exactly how to get there. I'm going to map it out because I want to get there as efficiently as possible. Google Maps is phenomenal because it's going to tell me the quickest route to get to where I want to be. Why not have a game plan or a map, a clearly defined plan that's going to get you where you are now to where you want to be financially, and be one of the 3%, not one of the 97%. So what are some actions that you can take right now to put yourself in a better situation? One, sit down with a member of our team for 15 minutes and do a risk exposure review. Get a good idea of not necessarily what's going to happen to your portfolio in various market conditions, but why it's going to happen. Because once you know the why, then you can determine if what's going to happen is comfortable for you. Have a retirement income analysis and get that clearly defined plan so you know exactly where your income is going to come from, how it's going to get there, and what you need to save in order to have the retirement that you've dreamed about to get you to where you want to be. And lastly, work to create a holistic financial plan. This focuses on 5 areas of planning: income, investments, taxes, healthcare, and legacy. But having a plan that's written, it's well thought out, and it's yours. It's unique and custom to you. So here's your opportunity to go ahead and schedule a 15-minute call with our team today. And this call is there for nothing more to answer questions, to see if there are thoughts or areas of concern that you may have, and to make sure that you're on the right path. And I'll end with this. What's the worst that happens if you have a 15-minute call with an advisor, or you go meet with an advisor? The worst thing that happens is that the advisor goes through and they say, hey, guess what? You're in pretty good shape. I don't know if I can help you. You're doing things, on the right path. You're on the right track. And you find out that, I'm not in the position right now to really need an advisor or want an advisor. But the best thing that happens is quite the opposite. The best thing that happens is now you have an advisor, you've met some people, and you're building a track to run on to get you exactly where you want to be. And hopefully it brings some clarity to you and your situation. So I urge you to take scan the QR code, click the appointment link, and have a 15-minute call with somebody, whether it's an advisor on our team, which we'd love to do, or find your own advisor. Thanks for listening today. All the best.